Hey, Dan Passarelli here. Well, with the VIX still above 20, it's at about 24.65 at the time I'm shooting this video here on Thursday. A lot of people are talking about volatility as if it's high. And to be fair, we have seen the markets moving around quite a bit lately, having a lot of that higher volatility. We have the VIX over 20. People tend to say that the long-term average for the VIX is 20, and so it's been above that for a while. So it seems like volatility is really high, and which would imply maybe it's a good time to sell options. But in fact, in a lot of cases right now at this time, it's just the opposite. I found many cases where implied volatility is actually underpriced, which makes for really good long option trades. Take Meta, for example. Facebook changed its, first of all, Facebook changed its name to Meta a while back, and they changed their stock symbol from FB, which it's been forever, to META today. Now, if you look at Meta, never mind the stock price chart, but let's look at the volatility chart. The historical volatility is 53. What that means is that the stock's annualized standard deviation is 53. And so what that implies is that if we were to buy, say, a straddle today that had 3 weeks to expiration, if implied volatility stayed exactly where it is at 53, and we bought that straddle at a 53 volatility, we'd typically break even. Now that's a little oversimplified, but it's about right. Now here's the thing though. We can actually buy this straddle at a much lower price. If you look at the options, again, 53 is the historical volatility. The options, if we go out to like 36 days here, they're trading below a 43 volatility, a full 20% lower, 10 volatility points lower. That means that buying a straddle is a really great deal in Meta, Facebook, right now. Now, that said, Facebook's not the only case. If we go to, for example, Chewy, that is another one where if we look at the historical volatility, it's 127. Now that could be this rather larger move here that was a result of earnings. So even if we just remove that, this bump up in historical here, it's at least a 110 historical volatility. But you can buy options in the high 80s with 8 days, in the low 80s with 22 days to expiration. So you can find a lot of examples like this, and buying underpriced straddles just simply means that the time decay is going to be lower for you, which makes it less punitive if the stock doesn't move. And in a market like this where the stocks are moving a lot, it's just more likely for it to be a winner. It's a low risk trade, and I've been looking for a lot of straddles lately. This is Dan Passarelli, Trade Smart.